Hello, everyone, and welcome to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options, and I'll be facilitating this session tonight with Rob Roy. I'll introduce Rob here in just a few moments, but as always, we need to go through some important housekeeping details about the session. First and foremost, this is our live disclosure disclaimer agreement. If you've attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website to be read in full detail there. Feel free to take a screenshot of it if you like, but that's the main point to take away. All right, so for this session, we are live streaming to multiple different platforms. Rob holds a brief Q&A session right at the end after going through his presentation and some case study considerations. So with the time allowed, we'll pass through as many questions as we can. So we have our Zoom audience, of course, and we're also live streaming to Twitter, Facebook, and YouTube. So it'll be a combination of questions from all of those platforms. As you'll see circled on the screen, please feel encouraged to write your question into the Q&A window at any point. And again, if time allows, it will potentially be passed through. Just know if we don't get to your question, it has nothing to do with the validity. We just only have so much time. And also take that as encouragement to attend the insiders meeting if we don't get to your question, as there's a 45-minute portion of that session solely based on answering questions for our subscribers. So obviously a much higher likelihood of getting your question addressed there. We also have the chat window as well. Any support related queries I can handle in there, or for any interaction amongst other attendees, please feel encouraged to use that window. Just make note that at the bottom it defaults to host and panelists. So if you would like everyone on the webinar to see your message, be sure to change the to everyone. All right, well, the market pulled back from that 61.8% level Rob's been talking about, and we're still waiting on some upcoming news from the Fed Summit in Jackson Hole. So should be an interesting session here to discuss with Rob. Look forward to, of course, hearing his analysis and interacting with you all. Thank you all for joining us tonight. And at this moment in time, I'll introduce who we're all here for. Welcome, Rob Roy.
Thanks, Zach. Thanks, everybody. And welcome to this week's TradeFinder Live. If you haven't been to TradeFinder before, this is a brief rundown of how it works. And there's my ugly mug that you get to look at throughout the hour. We talk about the markets. We'll talk about not just the U.S. markets, but the international markets. And I encourage you to stay in touch, even if you're only interested in the U.S. markets, because all the symbols that we talk about, even representing international markets, are tradable in the U.S. markets. And oftentimes there's some pretty good patterns on some of those securities. Then we'll go through and look at any closed case studies from our trade alert service that we send out to our EWO alert subscribers. We'll talk about those. Then we'll review case study considerations from previous trade finders, and I'll go through a brief overview of what the difference is. We'll look for a case study consideration for tonight, and then we'll open it up for the Q&A, and Zach just did a good job of going through and talking about how the Q&A works. So with that, let's just go ahead and take a look at the markets. So as Zach mentioned in the intro, we pulled back from the 61.8% fib level. I was a little surprised to see the gap down yesterday morning through that 420 level. I wasn't really surprised to see a gap, but I was surprised to see it gap down through 420 so easily, because that is a pretty significant point of support resistance. It has been for the entire year. So you can see that we got above it, came back down, tested it on Friday, and then boom. The gap opened yesterday. So then we want to look at two things. We want to look at the moving averages, and we are trading below the 10-day moving average. Little bit of follow through today. Try them out, some sort of a rally, but not a whole lot. We're a tiny bit oversold, but not significantly so. And then when you take a look at volume, if you're long the market, this is the thing that you can hang your hat on, is even though yesterday had increasing but still below average volume was pretty weak today. So a little more volume yesterday, almost nothing today, as we move down towards the 50-day moving average. And as I mentioned, the Federal Reserve is having their annual Jackson Hole symposium this week. Chairman Powell scheduled to speak Friday morning at 10 a.m. Eastern time. And so will we have much more action between now and then? Perhaps. I think we could have some more volatility, but I think it'll be balanced between movements to the upside and the downside, just waiting to see what the Federal Reserve has to say. Listening to the market pundits, not many people expect them to be dovish at all. They're expecting some pretty hawkish commentary. It's almost getting to the point where I've been talking about for a while that I felt the Federal Reserve would do too much. They'd raise rates too long. They'd overshoot the mark. They'd throw us into a recession. And then we'd go from raising rates one meeting to cutting rates the next meeting. One thing that's troubling me a little bit about that is a lot of people seem to be saying the same thing now. And as you know, if you've been watching the markets for very long, when everybody starts to view the markets the same way, often the markets go the other way, or they do the opposite of what the crowd thinks. So the more and more people that are saying that, yeah, the Fed's going to stay hawkish, they're going to go too far, they're going to overshoot the mark, makes me a little bit nervous about that thesis. I still think we're okay. There's enough people thinking that, inflation is coming down on its own. It's helping the Federal Reserve. They're not going to have to go as far. There's still enough people saying that to where I'm not significantly troubled by it, but I just wanted to bring it up, is if we start to get too many people on that same thesis of the Federal Reserve will overshoot the mark, then they may come out and surprise us and not be as aggressive as we once thought they might be. So we'll see how that plays out. I just wanted to bring that caveat up because those are the things that go through my mind. I don't like hearing a lot of people all saying the same thing because when that happens, that's usually not what the market does. So we still have a little bit of room to the 50-day moving average. We're still a tiny bit oversold. A little bit of a rally back up to 420 would make sense to close that gap, get back to the 10-day moving average. But, as you saw back over here in June, sometimes it takes a while to close the gaps. They don't always get closed immediately. So could we move lower? We could. I just don't think we go significantly one direction or the other before the Fed meeting on Friday. I just don't think traders want to get caught too much on one side of a trade or the other. So that's pretty much it as far as what's occurred in the market. Now, in the last weekend update, talked about is the Federal Reserve finally doing what they said they were going to do, which is withdraw liquidity. So that is a double whammy. We talked about that 2 weeks ago in our update. For those of you live streaming, welcome to everybody. If you're on YouTube and you haven't visited our channel, please visit our channel at Elliott Wave Options. But last week we talked about how the Federal Reserve may be finally starting to withdraw liquidity as they said they were going to. We showed you the Fed's balance sheet, which had just started to roll over just a bit. And then we take a look at the TNX and you can see we're climbing back to the upside. So interest rates are moving back higher, which would make you seem to think that they are withdrawing some liquidity, because with the market moving down yesterday, notice that interest rates went up. When the market moves down like that, normally money will go rushing into the bond market, meaning there's buying in the bond market and prices and yields move in opposite direction. So if prices were going up because of buying, yields would have come down. But yields actually went up yesterday, even as the market came down. I think that's indicative of the fact that perhaps the Federal Reserve is finally starting to do. They delayed it a bit, but they're finally starting to do what they said they were going to do, which is reduce their balance sheet. And so that's allowing interest rates to start to move back to the upside. It's going to be a very difficult time for the markets to move higher in that scenario, if that is indeed what they're doing. That's why so many people are focused on what Chairman Powell has to say on Friday. Going back to the Qs, we'll look at the Qs in a few minutes. That's a pretty difficult time for the tech stocks as well. If we start to get interest rates moving higher in an inflationary environment, et cetera, it's just going to be tough for tech stocks. Looking at the dollar, you can see that we had talked about how we had gone right to that wave 5 target all the way back in July 14th to be exact. And look where we are. We're right back there. As soon as we hit that high today, we backed off just a little bit overbought with the dollar. But this is another indication of strength in the dollar, rates moving higher, that the Federal Reserve is likely reducing their balance sheet, perhaps even withdrawing liquidity, and that's creating more support. So from this scenario, even though we're a tiny bit overbought now, so we could pause another couple days on the dollar, likely to see the dollar move higher. We only had a 51% wave 5 extension, so we could move higher from there. And then going back to rates, you can see, getting up over 4% on the 10-year. I don't see how the markets handle that very well, but that's a target of where we could be going. And we have a pretty nice fib level support with that wave 4 right at the 38.2% fib level. So that looks pretty good as far as potentially moving forward as well. So looking at those things, I think some pretty challenging times ahead for the market, at least by the change in what's going on in the TNX and the dollar, meaning that perhaps the Federal Reserve finally is starting to soak up some of that excess liquidity that they had pumped in. Now, one thing that I wanted to share with you is going back, and we look at this as far as we normally will take a case study consideration from our alert service, which is EWOtrader.com, our alert service. Many of you that have watched before know that we have a new AI-based time strategy, and that's artificial intelligence computer analyzing over 300 data points, giving us a potential for a stock to stay in a range following a big drop. And we put on some sort of a strategy, whether it be a calendar spread, a diagonal, or a butterfly, that allows us to capture a drop in volatility as well as time decay. I showed you a whole bunch of those results, and I thought I would come back and update you because we've closed a bunch of those. So you can take a look at this on what's occurred since the last week. We had HEAR, that was a nice 80% gain. And then on the 19th, look, we closed DHC, FTNT, MTCH, SWK, all of those on the same day with a 30, 41, 24, 18, almost 19% gain. All of that occurring on the same day, August 19th, which is since we talked last time. And then we had Snap that goes back to August 4th, but all of these are August positions in that new AI-based time strategy. So if you've been following us for a while, if you've been watching our YouTube videos and have considered maybe becoming an alert subscriber, what better time than now when we have this AI-based time strategy that allows us to capture a volatility drop, and it allows us to capture time decay, and you have protection to the downside in the setup of a put calendar spread. So all that's occurred just in this month of August. And since we have put this, which was September of last year, since we went live with this to our alert subscribers in September last year, we have not had a losing month. Knock on wood, not a losing month yet. So just wanted to share that with you, update you. And if you want more interest or are more interested in how to become an alert subscriber, you can go to our website, EWOtrader.com, find out more information there. I would encourage you to do so because we're pretty proud of this AI-based strategy. You may have seen on CNBC or other places, they're talking about how AI is likely in the future of technical analysis. All right, so let's go through and look at some of the rest of the markets before we look at our past case study considerations from TradeFinder. So we'll take a look at the diamonds, the DIA, and you can see that movement to the downside, a little more movement lower today in the diamonds, I think, than we had in the SPY. Same things here. We want to look at volume. Interesting that we had increased volume over yesterday in the diamonds, where in the SPY we had decreased volume from yesterday. So what does that mean? Well, a lot of people are viewing, it used to be that the Dow was everything, right? The 30 best companies, the industrials, the industrial revolution, et cetera, all that stuff. The Dow is everything. And then it moved kind of towards the SPY because, or the S&P, because that's the 500 blue chip companies, and it's a greater representation of the market, et cetera. Now it's kind of gotten to the point where the Dow is value and the S&P is growth. then it's not quite that simple, but that's kind of how things have played out. So if you look at that, you would think that value down day with more volume versus growth minded in the SPY still down, but on lower volume. So for whatever that's worth, we're now down close to that 50-day moving average, a little bit higher on the wave 4, 68%, but still a very qualified 5-wave impulse pattern to the downside. Really not too much to be concerned about if you're long the Dow until you get down to 320. If we break 320, then you start to get concerned, because that's the area of support resistance. There's a little bit where we are right now, as you see this, with some support there in February and March at 330, and some resistance there in May, June. So we broke through that, and you can look at that and say, yikes, that was pretty easy. We went through that in 2 days. But 320, I think, is even more important. So don't be too concerned unless we break 320. Then I think you start to get really concerned with what's going on there. Looking at the IWM, small caps, and we'll look at the Qs, and right back down to 190. So we've talked about this so many times, the trading range, where at the beginning of 2022, we were between 190 and 210, and then we had the drop down. And so the range moved down between 190 and 170. So we're down here. And then we broke back above 190 in this little summer rally. Now we're back testing 190. So the next couple of days are really important for the IWM. And note that we are not oversold on the IWM. The high of the day almost touched the 10-day moving average. So it's just kind of status quo there, right at 190. Can we hold it? That'll be the key. If we break below it, very likely we're going to go all the way back down to support again at 170. So looking at the Qs, as I mentioned, difficult times ahead for the Qs, I think, with the potential of the Federal Reserve actually doing what they said and withdrawing liquidity. Not too significant of a move to the downside today. If we take a look at volume, you can see that, as with the SPY, less volume today than we had yesterday. So that would be encouraging. A little bit oversold, not significantly oversold, but breaking back below 320. So the Qs have already broken back through their major level of support resistance. So that's not a positive thing. There's a little bit of support at the main level of 300. And if we can't hold that, which is not a super strong level of support, we're very likely coming back down to 280. So the next few trading days are very important for the Qs as to whether or not we can close this gap and get back above 320. If you're along the Qs, you desperately want them to get back above 320. Holding below that probably means 300 and maybe even 280, and the potential of moving down and setting a new wave 5 low or some sort of a new impulse pattern. So some of you very familiar with impulses could say, well, okay, we had the wave 5 end. You've already talked about it in the weekend update. Go watch that weekend video of how we retraced 61.8%, dead on the nose, right with that doji. So I don't want to go through and do that again. It's already out there on a video. And you might be thinking, okay, well, could this mean that that is an A wave impulse and we're making a B wave, and then we still have the potential for a C wave higher? And the answer to that would be, yeah, that's a possibility. With that wave 5 finished, you're supposed to retrace 61.8%. We hit it absolutely dead smack on the nose. Again, Elliott wave Fibonacci stuff is so amazingly accurate. But could this be a setup here? It absolutely could be. So if you're bullish, that's what you're looking for. That's what you're holding out as far as that being a potential setup. We're not there yet. Obviously, we would have to finish the B wave correction and start back to the upside, but it's the potential there. Yeah, the potential is there. And I know sometimes people say, you know, you talk about both sides, so you're never wrong. I don't talk about, this is not about being right or wrong. what I'm trying to do is analyze the Elliott wave patterns. The only reason I come on and do these things, we actually spend money to come on and do these things with our programmers, etc., devoting time and all. For me, it's very important to try to help the average person. This is a true story. I was a financial advisor for a while, and I became a registered securities principal, and that meant that I had to go to required meetings with the big boys, right? The investment management firm. And in those meetings, it was the same theme every time. They were talking about their bottom line. How can we improve our bottom line? Never did they talk about the clients. Never was, what can we do to make this experience better for our clients? What can we do to make our clients have a better return? None of that was ever talked about. And so it was really frustrating to me. So if I can do this and devote a little time and try to give back in what's provided a very good life for me and my family over the past 25 years, then I'm willing to do that. But this is not about ego. This is not about being right or wrong. I know I'm going to be wrong, but what I am trying to do is analyze the charts and give you the best information that I can based on a lot of years of experience, a pretty decent amount of knowledge on the Elliott wave. That's what it's about. And so if there's a potential for the market to move both ways, I'm going to tell you that, not because I want to come out and say, hey, the market's going to go up tomorrow and be right, and that be some sort of an ego thing. You know, that's not how you become successful as a trader. You become successful by analyzing what the market's doing, listening to what the market's doing, and trading when the percentages are in your greatest favor. And when they're not, pausing, not doing anything. That's how you become a successful trader. All right, that's my soapbox for the evening. I'll move on. So we want to look at Bitcoin. So let's take a look there at Bitcoin. As you know, we tried to get above that 24,000 level. We couldn't do it. Back down. Look at that doji. Oh man, what's going to happen tomorrow? Something's going to happen tomorrow. But we got down to 20,000, and then we formed this. We talked about this in the update where we had this really nicely formed ascending triangle, which Bitcoin clearly broke to the downside out of, got a little bit oversold. Even today's pause, we're still oversold. But with that doji, and I know they trade 24/7, but also they do give a print so that we can do end of day charting, et cetera, just like the futures, et cetera, that continuously trade. But looking at that still makes me think that there is some indecision on where we go from here. And if we can break back above 24,000, then the next level is 28. But now at this point, the concern should be, can we hold 20? Because we're likely going to come down and test that 20,000 level. We were a little oversold after yesterday's move, so little small doji there. Maybe something changes tomorrow. Maybe we head back to the upside and this becomes a false breakout, because you cannot call that a confirmation day today. So we had the breakout day yesterday, but that is not a follow through or confirmation day. And you know that that's really important. If you listen to any of the videos that you have to have when you break a major moving average, support, resistance, triangle, etc., you have to have a follow through or confirmation day. We didn't get that in Bitcoin. So there is slight possibility that we move back up towards the point of the triangle of 24,000, and it's no harm, no foul, and we start over. But it just feels like we want to go down and test 20,000 again before we do that. We'll see how that plays out. Looking at the EWA for Australia, and you can see that moving back below the 50-day moving average on the Aussie. So interesting there, a little worse than some of the US markets where we're still holding above the 10-day moving average, but well, not on the SPY. We broke below it there. So same thing here on the Aussie, but below the 50-day moving average is of significance. And can we hold 22? Just not a whole lot there. We did break above it, which was important, and we ran up to 23 and then got knocked back. So can we hold that on the way down? If not, then the likelihood is we're all the way back down to 21. And that could probably happen in a short period of time if we can't hold 22. So if we can't hold that level, then pretty quick move back to 21. And then we decide from there, will that wave 3 level hold or will it move on? But note it is a qualified 5-wave pattern to the downside. Looking at Canada with the EWC, at least we held the 50-day moving average here. We tapped it on the low, still holding it 35. More importantly, than the 50-day moving average, in my opinion, because there's a lot of support resistance there. But the fact that the 50-day moving average is right on 35 is helpful. A quasi doji there, not a classic one, as well formed as the one in the EWA for Australia, but something to consider there. Looks like something may happen in the markets tomorrow with these dojis. We'll take a look at INDA. India, as you know, had done so well with their move back to the upside. Not really having a significant retracement of this vertical move was especially impressive to me, but now we're kind of coming back down. So maybe it was just a little bit of a pause there. Usually when you have a vertical move, it's retraced fairly quickly. I know I talk a lot about a breakout of a triangle will get retraced, but we don't know when. It could be right away, could take some time. Gaps get filled, sometimes right away, sometimes it takes some time. But usually when you have a big vertical move, that's a pretty quick retracement. That's what usually happens. It didn't happen that way on the INDA, but now it looks like maybe we're trying to come back down. So a little bit of a bounce today, which is encouraging. And as long as we stay above that 42 level and above the 50-day moving average, then I think you have to stay bullish on INDA. Came within a hair's breadth there of disqualifying this pattern, but it's still technically qualified. So you have to be careful with that, that the pattern to the downside is still technically qualified. But we'd have to get below the 50-day moving average and support at 42 first. So again, that market looks a little bit stronger than some of the others. And then there was a lot of chatter about Germany on the networks today, as far as could they come out with some negative inflationary news that could send the German market down lower. I mean, goodness, it just looks like Germany wants to go down to this 19 level. We held that wave 4 at 38.2% and significant resistance there at 24. So now we're down here at 22. The most positive thing you can say about this chart is we're oversold. So we didn't get much of a follow through today, but we had follow through on the previous days. So we're probably coming down to test that wave 3 low at 21, but maybe not for a couple days while we allow this 10-day moving average to catch back up. Try to hold support there for a little bit before moving lower. But man, that looks like Germany's at it again as far as another 5-wave pattern to the downside, which it's done so many times, so often over the past year and a half. You've heard me talk about that numerous times, time after time after time. All right, so now let's go ahead and take a look at some of our past case study considerations. We have Reliance Steel, which goes all the way back to May 3rd. And if we take a look back here, there's May 3rd. And then we move forward and we adjusted this to the downside for our alert subscribers. And you can see how it's moving lower, and we will stay in a bearish position on RS as long as we stay below 200. We're gonna have to break that 50-day moving average at 185 or so, but below the 10-day moving average. So we break below that, I think we quickly come down to 160, and that's kind of what our target is. That's what we're looking for, to see that happen. But we got to break that 50-day moving average first. So if you're following along with that, HZO had a pretty nice move following Walmart's earnings report. Everything retail went up, but now we're coming back to the downside, and what the level we're watching is right where we are right here at 40. If we can hold that, then we could bounce back to the upside. We'll see what happens with the regular market, but if we start to break below that, then that's a really good short, because we're likely coming down to retest that wave 5 low right there at 36, and we'll want to take advantage of that because it's about a 5-point move. But watching very closely to see if we can hold this level right at 40. And then going into 2 weeks ago, we looked at AJG and we said if it held 180, which it did, and then you can see, so we were there at 182, made it all the way up to a high of 191, so a 9-point move. Really nice move. We've pulled back a little bit with the market. So again, the difference here, when I showed you the page at Elliott Wave Options, EWOtrader.com, on the alert service, we send out alerts via text message and email to our alert subscribers for entries, any adjustments, and exits. So we let you know what we're doing and when we're doing it. On Tuesday nights with TradeFinder, we look for case study considerations, but then you're kind of on your own as how to manage them, what strategy to put on, what trade to put on, etc., and what to do. So you had a 9-point move. How much profit do you want? That's your choice. What would you do with it? We did break below the 10-day moving average today. Does that matter to you? You're still in a profitable position. Those are the things that you have to come up with on your own. If you're following along with our case study considerations each week. And then last week, we looked at KDP, Keurig Dr. Pepper, and we said that we were looking for a move up towards 42. And then we had a pretty nice DMI, but it was getting up there. And you can see that, wow, we had a really nice move up to 41.31 that occurred on the 18th. We've pulled back a little bit, so we didn't quite hit our target price up at 42 yet, but still had a nice move there to the upside. So still looking profitable. The key is the positive directional indicator has moved below the ADX, and the ADX has gotten above 40. Now that's telling you the strongest part of the move is over, and now the ADX is rounding. If it breaks below 40, that's an exit signal. So, this one you needed to be quick on. We knew this would be a short-term in and out. Didn't quite make it to 42, but got awfully close. So watching that, you would want to watch the ADX over the next day or two and see, can it bounce back above that 10-day moving average, get back above 40 for another run at 42, or do we want to just go ahead and take that one off and see how things happen? So that catches you up to date on our past case study considerations. Everything else has been closed out, with the overwhelming majority of them being closed out for nice gains. So let's take a look and see if we have any potential candidates for tonight. When you look at this search, this is a program, by the way, called Profit Source. To me, it's the best Elliott Wave software that exists on the market. I'm a massive believer in Elliott Wave. I've been trading it since 2001. Most of you know that story. I'll tell it again another time, but I want to get this done so that we can get to some Q&A here. But if you're a fan of Elliott Wave, or if you're new to Elliott Wave, this program is programmed exactly to the algorithm that Ralph Nelson Elliott wrote. There's a lot of Elliott Wave software programs out there, but the majority of them are personal adaptations of Elliott's algorithm. This is programmed directly to it, which I personally like. And from my experience, and I've tried all the ones I know to exist, it's been the most accurate. If you're interested in it, you can find out more about it at hubb.com. You can see there is one impulse result there, and that's back to the food. Back to foods. Well, we know food inflation is real. If you've been to the grocery store, you know food inflation is real, and it hasn't gone down much at all. So this is Hormel Foods. And if we take some of this stuff off here and see what it looks like, you don't want the positive directional indicator moving down on the day when the stock is up. That's slightly concerning. If we look at the Elliott Wave pattern, it's not in a 5-wave impulse pattern. We're on the retracement following the completion of the wave 5. We went back to the previous 4. That's exactly what's supposed to happen. That did happen. So now we're looking to see, okay, where's the next impulse move? So are we on an impulse move higher? It kind of looks like it, doesn't it? I mean, we've had a little bit of volume, but not really much. Is well below average, just like the markets. And the problem here, I think, with the DMI is you really want to see that positive directional indicator move back up on a day when the stock is higher. But when you look at the moving averages, we're crawling right above that 10-day moving average. This doesn't look that bad. And the potential to go back and test that previous wave 5 high back up here at 55, I think exists with the amount of food inflation that we have. If the consumer really starts to have a rough time with a recession, then that's going to affect spending everywhere, right? Consumer spending will be an issue across the board. We're going to still buy food, but it's going to, it's going to hinder, buy as much perhaps. But I think that from a defensive sector, that one's pretty interesting. So we would look for that to potentially move back up towards 55. I don't know that we're going to find anything else much better than that, but let's take a look and see. So let's look at some of the consolidating stocks. The VIX did move lower throughout the day. It got down to 23 on the low, but it closed back above 24 again. And as long as we can stay below 25, we can look to do strangles. So if we look at our consolidating stocks in a bullish wave 3, there's one on Omega Healthcare. Let's see if that looks like some sort of a triangle pattern. You can see that the ADX is below 13. That's why it showed up. Take the oscillator off, but that's not, that's kind of an odd pattern. There's no doubt support resistance is at 32, and we did have an ascending triangle, which it broke to the upside, and now it's coming back down to test that level. Interesting pattern. Not what we usually do with triangles. We would have been more apt to enter it back when it was around the 32 level before the breakout. But this is one of the methods of when triangles form, they break out one of 3 ways. You get a breakout, a test of the breakout, and then a continuation. You get a vertical move, which those are the most fun because they move really quickly in a short period of time. And then you get a false breakout where the big move is to the other direction, which is still in play here. So 2 of the 3 are still in play, where we could just be testing the breakout and then we continue on, or that was a false move and then we move lower. Let's see if we can find anything that might be on the bearish wave 3 with some of the downward moves. Maybe. Nope, nothing there. So let's take all those off and see if perhaps we can Dollar Tree. How about that? Let's just take a look there and see what kind of yeah, that's fairly interesting, isn't it? Pretty nice looking triangle there on Dollar Tree. It's $165 stock, so it might be slightly expensive, but that's a pretty good looking triangle. So I'm going to keep that one in the mix. Let's see, the high is 175, the low's 150. So it's a 25 point. That's enough. We look for a 10% breakout from the size of the triangle, meaning the width, the mouth of the triangle from the high to the low in the widest part. So that's pretty interesting. Let's see if there's anything else. Dollar Tree's in play right now. Airlines, how about Southwest? Man, there's a lot of interesting looking ones on there. So looking at Southwest, pretty low ADX, and I don't think this triangle is quite as good as the Dollar Tree one, but it's there nonetheless. And it's what, 35 to 42, 7 points. That's pretty decent looking actually. And when you look at the history, one of the things you look at when you're looking for strangles is, can the stock move? Does it move historically? You don't want to put a strangle on a stock that is consolidated, but then when you go back and look at it, it's gone sideways for the majority of the time. So let's try that. We haven't done a strangle in a while, so let's do that. I think Dollar Tree is pretty interesting, but for tonight, for this one, 823, we're going to do love in a strangle. And let's see how that works out. I'm just pretty intrigued by the fact that we had this vertical move to the downside here, and then we consolidated. When that's reversed, when it's to the upside, where you have a vertical move higher, and then you go into a symmetrical triangle, that kind of formation, I love that pattern. That pattern always breaks out. So we have the exact opposite of that here. We had a vertical move lower with a symmetrical triangle. It's not quite as reliable as the upward pattern is, but I think it merits taking a look at. And with where the markets are right now, are we headed lower? And I think this is a good opportunity here. A lot of people chattering about oil prices moving to the upside. Perhaps in the Q&A, somebody asked about USO. I didn't show that because I thought that might come up. But OPEC came out and said they are not happy with the drop in oil price, and they may consider a cut in oil production. Can you manage can you believe that with what we're paying at the pump? The fact that OPEC is angry that the prices come down and they may cut production. Pretty amazing stuff. All right, with that, Zach, I'll turn it back to you and let's do some Q&A.
Awesome. Sounds great. Thanks for that presentation, Rob. As always, tons of great questions and comments coming through. First, I want to share with you that from both our YouTube audience and Zoom, there's been tons of thanks for all the effort you put into all of these services, and they showed a lot of appreciation for everything that you do. So it's easy to hear the negative feedback sometimes. So not always, people don't always speak up to share the positive side. So I definitely wanted to pass that through to you.
Well, thanks. I appreciate that. And, I got off a little bit on a soapbox there, but thank you for all the comments. It's very much appreciated, sincerely.
Absolutely. And so we'll start out here with a question from Will on YouTube. I've heard some Elliott wave technicians talk about long-term S&P 500 hitting a new high above 5,000 next year in a wave 5, then a major decade-long secular bear market. Do you agree?
Let's take a look at a longer term time frame, and that's what they're looking at there. So there's an Elliott wave theory called follow the higher degree, meaning that no matter what time frame you look at a higher degree, see what it's showing you. And so when you take a look at the weekly chart, you can see that clearly 420, whether it's the daily or the weekly, is an area that's been support resistance for at least the better part of this year. But even going back towards last summer, you can see that we kind of traded through this area for a while. It wasn't as much the support and resistance as it was just we kind of traded through that area, consolidation more than support resistance in that area. So that just adds to the importance of the 420 level. So here's what they're seeing. The wave 4 came down 57%, awfully close to 61.8, didn't quite make it. Man, I'd be really on this if it was 61.8, because that's the strongest fib level in my opinion. So I really pay attention to those patterns when we hit that level. But we could easily be, you can see the zigzag to the downside there that we had right here on the way lower. And then taking a look at the move back to the upside, are we in a zigzag move back higher, which is kind of what we were talking about earlier. Only a 28% correction, so that's really not at a fib level. So you really wouldn't want to talk too much about that, more than that's just a pullback within an impulse move. But how we handle this 420 area is going to be key. And then as you can see, the next level up there is 460. And so what the Elliotticians are talking about is there's your wave 5 target up there. And so there's your 5,000 plus level. That would be in summer of next year. Is that a possibility? I think so. We talk about the Federal Reserve overshooting the mark and then having to cut rates again. If they get back into an easy money scenario, that will propel the markets higher. Liquidity is so important to the markets. How long do we have this period of time of reducing the balance sheet and withdrawing liquidity. Could we even come down and take out that low and go to 61.8? That's a possibility. But as far as do I agree with this potential scenario? Yeah, I can see that. How far do we go to the downside in the meantime, I think is the question. And I go back to the fact that liquidity matters. How the Federal Reserve handles it matters. And historically, this Federal Reserve has been dovish. There's a lot of people saying that they're going to be hawkish till the end. Maybe they are. But once they pivot and then they start taking away this tightening regime of raising rates and reducing liquidity, the markets will be free to move back to the upside. As you know, the markets normally move higher, but there's always corrections within the move to the upside. People are constantly putting money away in IRAs and 401ks. Money goes into the market every single month. And so the markets traditionally move back to the upside. The question just becomes, is the bottom in yet? Could we test that bottom, slightly break it? I think all those are possibility. But going back to the original question, yeah, I think summer of next year, could we be back at a new high in the 5,000 range? I absolutely think we could do that. And there's a chart that's showing it.
Very well. Thanks, Rob. To continue on, you mentioned the Fed reducing liquidity. Paul actually had a question from Zoom. Does that mean that the Fed Reserve is dumping bonds into the market?
That's the big question. They are up until the past 2 weeks, they had just been letting bonds expire, which is called rolling off the balance sheet. So what that means is that they're not injecting liquidity because they're not rebuying the bond, so they're not injecting liquidity. It's a quasi, withdrawal liquidity because they're not continuing with the liquidity, right? So liquidity is not as high. So do you consider that a withdrawal liquidity or reduction in liquidity? You'd have to, because they're not rebuying those bonds, they're just letting the old ones expire. Now, there's a difference with the question that you ask of, are they dumping them, meaning they're selling the bonds, not holding them to expiration and letting the bonds roll off. They're actually selling them and dumping that back on the market. I think there's some of that has occurred in the past 2 weeks. I think that's what rates are showing, and I think that's what the dollar is showing. And I had said, 2 weeks ago, the Fed's not doing what they said they were going to do. Well, the balance sheet has rolled over. They're doing some of it. How long will they do it? How long will they continue it? They're going to do it until they get inflation down to where they think it needs to be. So far, they haven't been withdrawing liquidity anywhere close to what they said they were going to do. 95 billion a month was what they said, and it's been nothing close to that. But some of it's going on. And yes, I do think, again, long-winded answer to your question, they have been dumping some bonds the past couple of weeks. How long will they continue that? We'll find out together.
Yes, we will. Next up, Kenny from YouTube would like to look at natural gas.
Yeah, I figure we would be talking about that. Natural gas had a major midday reversal. It was trading higher, significantly higher, as a matter of fact, up until almost noon time. And then right at 1 o'clock, that's that drop that occurred. But when you take a look at it, it had gotten a little bit overbought. Looking really hard at this. If you go back historically, August, September are times when typically they're positive for natural gas because you looking ahead to the winter time, right? And then after you get out of September, the market looks ahead, so it's already looking towards springtime, and natural gas tends to come back down. So from a seasonality standpoint, if that's something that you watch, we're in an area between now and September that is normally a bullish time. Well, we've had a pretty good run, and then we had this reversal, but we did hit the 10-day moving average on the low and close above it. So what I'm watching for over the next couple of days, or do we try to bounce back to the upside? If not, what I'm looking at is a potential butterfly somewhere, and it's not that expensive at all, between 30 and 20 with the midpoint of 25. And this is why, because you see all that support congestion in there. So if we break that 10-day moving average and we come back down towards that 30 level, I think that makes sense, is that we break down here, we hold this wave 4, so we got support there at 20, and it's not a very expensive butterfly considering the width of it, 10 points wide, moving into September. But you got to wait, because again, moving into September historically, there's been some bullishness, so perhaps this was just an overbought correction back to the 10-day moving average, and then we bounced up. There's still that wave 5 target just below 40, but we've marched nicely up, high today all the way up to 34.5, right at that 35 level. So I think the next day or two, I mean, natural gas has been absolutely flat since that drop, hasn't done anything, which kind of plays into our AI-based time strategy, doesn't it? I mean, if you looked at the 3-minute chart on natural gas, that's exactly the pattern we look for in our AI-based time strategy. So that's how I view natural gas right now.
Very well. Thank you, Rob. Next up, we'll transition back over to Zoom. Eric says, thank you, Rob, for all you do. Would you please look at AMSC?
Sure. AMSC. Nobody wants to look at your Bed Bath & Beyonds, eh?
Oh, well, I imagine it kind of scared some people away.
Yeah. I did want to bring up the AMC ape thing, though, because I want to talk about that. I had forgotten it. It's on my notes, but I'd forgotten to look at it. So American superconductor here, you can see resistance there held so far at 6, but support is at 5, which is crucial to hold, as you know, from an institutional standpoint. You look at volume there, and yeah, you can see the volume that came in and supported it last time we got down there and was able to get it to bounce above. Man, all you need for this is to get above 6. It just has to get above 6. It tried, but it had a doji there, and then came back down. So between 5 and 6, I think you're neutral. If it breaks below 5, that's not good at all. But if it breaks above 6, then you've got an easy run up here to 8. So that's a pretty nice move there, and then potentially higher from there. And you've got a wave 5 that extended 50%, which is a big level there. So I think they're going to try to hold it here at 5 again, and then we'll see. That would be a quick trade, trying to trade it on a bounce of 5 back to 6. But your big trade there is if it breaks 6. That would be interesting. So I wanted to show you this, everybody. I know this is all over the internet now about AMC and APE, you know, the preferred. So do we even, I don't know if we even have APE yet. Yeah, we do. And so there it just started. So see that it's trading at 7, and AMC is trading at just below 10 at 9.5. Well, this is a good arbitrage play where they're basically one and the same now, right? I mean, they're pretty much the same company, and common versus preferred, but the same company. And there was a trade that was illustrated by a famous short seller that was talking about how he's short AMC, long APE. Now, in the olden days, arbitrage, John Henry, that owns the Boston Red Sox, made his fortune by futures arbitrage. And that was the difference in the futures and the spot market. Basically, he would do this kind of a trade because they always come back to match at expiration, right? So there would be a separation there, it'd be a significant arbitrage. And so he would just trade the difference between there. It was an expensive trade, but it wasn't that risky of a trade as you're looking for the spot market, cash market, and the cash market and the futures to come back together. That's all pretty much gone now. We don't really have that anymore with computerized trading, electronic markets, all that kind of stuff. Is that just, you know, back in the older days with people standing on the floor screaming, you just don't have the arbitrage opportunities. But this reminds me of that, where you think the likelihood is they're going to come and meet at the same place. So you short the higher one, you go long the lower one, And as they come back together, you make money on the short coming down, you make money on the long coming up. That's how arbitrage works. You can make money on both sides. And really, the thought process of the two coming together makes a lot of sense. Anyway, I wanted to share that with you because I thought that was super interesting. And we just don't really have much arbitrage anymore. And I know this is in the meme mania. And so a few of you I thought might be interested in that. Okay, Zach, on to something else. Next question.
No, that was very interesting. I appreciate you taking the time to share that. That was intriguing to listen to. We'll move back over to YouTube. I believe the name is Lonnie. It's an interesting question here. Do falling wedges often turn into inverse head and shoulders? Seems the cues and socks are setting up for that.
I don't think there's any rhyme or reason to that as far as is that a pattern that occurs? I mean, you could look at it from, you have a descending pattern, so it kind of quasi does it, but I don't know that there's a direct correlation between those two. But yeah, when you take a look at that, it's, I can see what you're looking at with the pattern. I think it's a little bit more of a coincidence between the two than there is a direct correlation, but it is something to keep an eye on as far as potential movement out of those markets for sure. Interesting question.
Yes, indeed. We have a question here from Juan on YouTube. Could you look at CRM?
We haven't looked at that one in a while. People have been looking at CrowdStrike and then Palo Alto. Palo Alto had a big move today. So looking at Salesforce here, you can see this support resistance level at 180. Just kind of not doing a whole lot since the wave 5 ended. Some flats in there, nothing from an impulse standpoint, really, though. They're just all flats. So what you have here is a very large trading range between 190 and 160. So you've got a 30-point trading range here. Jumping behind. So this one, this looks good if you're. I'm not a big fan of at the money butterflies, but if you were, I think this is one that looks pretty good. You set yourself up a 160, 190 butterfly, and the likelihood is 190 is clear resistance, 160 is clear support. The likelihood is you stay in between there. So I think that makes a lot of sense there on Salesforce. Absolutely. But as far as a directional move, you got to get above 190 or below 160. But that's a big range. So I like the butterfly idea better.
Yeah, it seems like there's a solid potential there for that. I see we are a minute after the hour. So as always, I'm happy to stay on as long as you are. You just tell me how many more.
Let's do a couple more and then we'll wrap it up.
Great. So John from Zoom says, please take a look at SU Suncor.
Interesting that the past few weeks there have been a lot of energy stocks looked at. Boy, they're at wave 4 right there. So this is the test that could occur in the markets, right? We just looked at that on the weekly chart of the S&P where we had a 57% wave 4 correction, and then Suncor came down and tested it. That exact same thing could happen in the markets. Easily could happen. But support here right at 30, right where that wave 4 is. And boy, if it can get above 35, you are off to the races there. There's nothing to stop it from going back to that wave 3 high and probably up to that wave 5 target. Going into this time of the year is typically, again, bullish for energy, as we talked about with UNG. I think I would play the more conservative card here. It looks like the 10 is about to cross the 30. You are above the 50-day moving average on today's move. For me, the more conservative trade, let it get above 35, and I think you have a great pick there. I think that's a good looking chart. It's a great Elliott wave pattern. Kudos for picking that one. However, I would let it get above 35 first, just from a little bit of caution.
Yeah, that's looking like a great setup there, and I'd say patience is the key.
All right. So, one more.
One more. All right. We'll say Chris from YouTube says, if possible and there's time, will Rob have a look at ENPH again? Much appreciated.
Sure. So energy is the theme tonight, so with natural gas and all these energy stocks. So, you know, we had the rollover, we got below the 10-day moving average. We needed to hold 280. We have so far. So that's the key. I mean, still, just like we looked at it before, it needs to hold this level at 280. You got danger, Will Robinson there with, and if you know what that means, you're as old as I am, but you've got a gap there and a gap there that are in question. So that's why it's so important to hold this level here at 280. If it breaks it, we're coming down to set this wave 4 very likely and fill these gaps. But as long as you hold it, you got to get back above the 10-day moving average too. But as long as you hold it, the consolidation is pretty impressive considering how strong the move was to the upside. I mean, we went from 220 to 280 in 2 days. So that's a pretty impressive move. It's held it pretty well. If it gets back above the 10-day moving average, then yeah, I think the march is on to 360. But the key, it's got to hold 280. It's almost so good that it's a bearish trade if it breaks 280, but it's definitely, you don't want to be long if it breaks 280. You can see it kind of dipped its toes in the water below yesterday, but it got support and it was able to close back above 280, a little bit more today. So if it holds 280, I think you got a pretty good long trade up there to 360. But if it breaks that 280 level, watch out, because 220 may be in the cards. It is, you know, a good time of the year for it, et cetera. So there's some fundamental things that are in support of it holding that 280 level. So go ahead and ask next week. I'm curious to see what this one does. Thanks everybody for your attention. As always, as you know, sign off the same way every time, but it's very sincere and very passionate. Time's the most valuable asset that we all have. And we very much appreciate when you devote some of your valuable time to us. And we really try hard to make it an informative and educational use of your time. Thanks so much again. As always, have a great week. We'll see what happens on Friday with Chairman Powell's speech. If the markets don't do much crazy before then, you can expect